you're new to the UK, you're a new investor or you're an old investor and you're investing, these are some of the tax mistakes for you to avoid. Number one is not taking advantage of the individual savings account. Now, what is an individual savings account? Individual savings account, or ISA, is an account that protects you from the taxman. So if you invest with an ISA, it could be a cash ISA, a stocks and shares ISA, a lifetime ISA, you're protecting your money, your capital gains, your interest, and your dividends from the taxman. So whatever it is you earn when you invest using an ISA is tax-free. ISA allows you to invest tax-free and also withdraw your money tax-free. While using a self-invested pension or like a SIP, you're able to contribute to your pensions tax-free without paying any tax to the taxman and just saving up your income. Number two tax mistake you should avoid is ignoring your capital gain allowance, CGT. Now, there is something called a capital gain allowance. Every individual residing in the UK has a capital gain allowance, a capital gain tax allowance, CGT. For every tax year, your CGT is £12,300. And if you do not utilize this CGT, you end up paying more tax, more unnecessary tax on your income, on your dividends, or your interest. So you need to utilize your CGT, your capital gains tax allowance, for every tax year that you invest your income. But three tax mistake you should avoid is incorrectly handling foreign investments. Now, for example, if you're going to invest in the stock market, you have to invest in the US stock market, there's a form called the W38BN form that you have to fill to indicate that you are a taxpayer of the United Kingdom. That way, you do not pay taxes in the US. If you do not do this correctly, you end up paying taxes twice. So you end up being a victim of double taxation, where you end up paying taxes in the UK and you also end up paying taxes in the US. So in order for this not to happen, you need to properly handle foreign investment and properly report your foreign investment income as well. Number four tax mistake you should avoid is neglecting your dividend allowance. Every individual residing in the UK has a dividend allowance of up to £2,000. Now, this is applicable to you if you're not investing using the ISAs, which protects you from tax. If you're investing without an ISA, then you're entitled and eligible to a dividend allowance, which is £2,000 annually every tax year. So you should make sure to utilize your dividend allowance to save you from paying extra money on taxes when you could actually be saving the money for yourself. By being aware of this common mistake, every UK investor is able to fully maximize their returns. Especially if you're a new investor, you're able to understand your tax obligations and fully maximize your investment returns.